What is going on, investors? Hopefully, you guys are doing well out there. Big tech earnings has begun. It always begins when Netflix reports their earnings. Company reported their Q4 earnings after the bell today. We'll go through them. We'll take a look at, obviously, there was some very interesting news that flowed across as it relates to the WWE and that product coming to Netflix. We'll come over here and look at the high level numbers. We'll drill down into the guidance as well, show you how that relates in the upcoming quarters. We'll take a look at the different regions as we always do with Netflix, and take a look at the high level financials, the revenues, the profits, the balance sheet, and the cash flows. And we'll come over here and look at this from a technical perspective. This one continues to inch higher in the after hours, initially up maybe about 3 or 4%. I'm seeing, at least when I record these things, look, these things can bounce around. This thing could be down by the time I'm done with this video. But as of right now, we're up about 6.5 points on Netflix. Let's talk about from a technical perspective, is this an area, are we breaking out? Sometimes you get these breakout trades. You can buy the breakout. We'll talk about if that is possible or if you should wait for pullbacks as it relates to Netflix. Over the last year, shares of the streaming giant up about 37%. That's kind of where I want to start things with Netflix. They had this slide inside of their presentation, and this is as of 12/31, so that's why it doesn't line up with what I'm showing you here, basically a month later on January 23rd. But look, over the past year, you have beat the S&P 500 performance, and you have beat the NASDAQ. You start stretching things out, though, for Netflix. They haven't actually done that well. Over the last 3 years, it is underperformed all the broad markets. Also, over the last 5 years, more or less kind of kept up with things and has lagged behind. You have to stretch this thing all the way out to kind of that 10-year mark, and certainly since the IPO, it's been one of the best performing stocks since its IPO. But look, companies like this just don't go public early anymore. They're staying private for super long. When they do come public, it basically is kind of an exit strategy for the executives and the venture capitalists, and then the average investor is left with equity that is more or less fully priced. So that's the thing with Netflix. If you're making the argument to buy Netflix today, this outperformance, which really hasn't shown up in a couple of years, needs to return. Now, we did get some clues on the Q4 earnings that some of that outperformance could be coming, because revenue came in at $8.83 billion. You finally had a resurgence of growth. We'll show that to you here in a moment. The fact that this company really wasn't growing. It was like growing kind of like almost flat, low single digits. Subtract inflation off of these numbers, and you're actually got negative growth over at Netflix. But in Q4, you did have a resurgence, and when they gave their guidance, you're also seeing a follow through on that. 12.5% growth year over year on that revenue side. We'll get into all the profits and all that here in a moment. But big news of the day is the fact that the WWE, which has been rolled up into this other public company called TKO Group, which I believe also has either a large ownership stake or full ownership stake in UFC, which is the kind of the hand-to-hand combat league. Netflix is going to be the new home WWE Raw. That's going to exclusively stream on Netflix starting in January of 2025. So we're still a year away of that, but also live events. This is also very interesting for Netflix. They've done some live stuff. I think they've done some live comedy stuff as well, but live events, these WrestleManias, these are really big, from a viewership perspective. And that will be interesting. Obviously all the content and all the other licensing stuff that Netflix can do with this. Apparently it is a 10-year deal with some kind of opt-out clauses after the first 5 years, but you can also extend this for 10 more years. Netflix basically having the option there. Now, this is just for WWE Raw and the large kind of one-off, they used to be pay-per-view events. Looks like still some WWE programs still going to be airing on Comcast, and depending on where you live in the world, some of it will be on Netflix, some maybe on other TV providers. But brings Netflix, if you want to call WWE a sport, certainly an athletic environment, Very interesting from that perspective. Now, back into the numbers, they were sensational. $8.83 billion. That was 12.5% growth, coming off a quarter where we did 7.8% growth. What's going to be the follow through for Q1 of the upcoming quarter? 13.2% growth. That's fantastic. $9.24 billion worth of revenue. Where does that line up with Wall Street? Well, basically right in line. Wall Street is expecting about 13.5% growth, right about $9.3 billion worth of revenue. That's where Netflix coming in. Probably are sandbagging just a touch, so they'll probably come in close to that 9.5, maybe even 9.6, 9.7 billion. Now, what's impressive is a reacceleration of their operating profits. This quarter had some slippage in the operating margins, although they were quite accelerated and higher than they were last year, where they were just 7%. They flowed into kind of the low 20%, slipped down to 70%. Look where your operating margins are next quarter. A healthy 26.2%. That's going to give you solid net income at about $2 billion. And I don't want to really brush over this. Okay, this is a $5 billion or in excess. Quotes, we don't get an exact value of this deal. $5 billion for a company that's doing, at least at the current time, about $2 billion on a really good quarter in terms of operating profit. This is almost, not quite, but almost 1 year of free cash flow, this deal for the WWE. So it is a big deal, okay? I know we look at Google and Apple and Microsoft, and $5 billion to them is really nothing, but to a company like Netflix, a $5 billion deal for some content is actually pretty impressive. Subscriber growth, we don't get any forward estimates on that, but impressive 12.8% growth, some of the fastest growth that we've really seen since everybody was locked down at home during the pandemic. They were growing at just 4% growth on that sub side. As I read through the shareholder letter, they are giving a lot of credit to the ad tier. So a lot of people signing up on that ad tier and opting to view ads as they watch shows on Netflix. You couldn't pay me to sit through a TV ad these days outside of watching maybe NFL football or something like that. Different regions, you have your United States and Canada, strong across the board. Strong paid additions here, getting strong average revenue per users. Also, look at your Europe, Middle East, and Africa. Wow, 5 million net paid ads. That's way over and above where you have been over the past couple of quarters. They're seeing acceleration there. Latin America also very strong on the sub side. Still having trouble squeezing out dollars there, but that's the nature of those kind of developing regions, if you will. Asia Pacific, also huge net paid ad, but from an average revenue per membership, still obviously, we're not expecting this to catch up with the United States or Canada or even kind of parts of Europe, but certainly that is the upside with Netflix if they're able to not only keep these subscriber numbers growing like this in the other regions, but maybe you can expand some margins there as well. The numbers, $8.8 billion, where you had a lot of costs chewed up. We talked about how the gross margins kind of slipped over at this company from kind of the low 20s down to 17. Where did that go? It went into marketing. You see, you went from 560 on the marketing side all the way up to 916. Big jump there. My guess is you have maybe some one-time cost here that won't reoccur in the subsequent quarters. That's why you see kind of that jump back into the 20% margins. Everything else was basically the same, and you see your operating income last year went from $2 billion, this is last quarter, $2 billion down to 1.5. When we look at it on a year-over-year basis, you do see that there's kind of these one-time marketing charges, my guess maybe like bonuses or something like that kind of show up in this December quarter, and then they go away and they taper off for subsequent quarters. Your net income was $1.7 billion last quarter, just $55 million a year ago. Again, this is why this WWE deal in excess of $5 billion, again, that's over 10 years, so it is stretched out over a long period of time. But to a company like this, committing to $5 billion, it's much more than like a Google and a Microsoft, which just prints that almost on a daily basis. Net income coming just south of $1 billion, again, in a quarter. Balance sheet, they've got plenty of cash, 7.1. It's balanced off by about $14 billion in long-term debt. The content assets is really where this company's value is. They've got nearly $32 billion worth of that. You see for their 3 months cash flows, $1.7 billion on the operating cash flows last year. It was just south of about $450 million last quarter. It was closer to $2 billion. They continue to buy back shares over at Netflix, despite the pretty rapid rise, even year to date. It's up only 1%, but over the last year, shares of Netflix are up 37%, yet the company continues to buy back about $2.5 billion worth of shares. That matches what they did last quarter. Over the last year, they've bought back about $6 billion worth of shares. I gotta think there's better uses for this money for a company like this, but they did say inside the shareholder letter that they are not interested, and I repeat, Netflix says in here they are not interested in buying any linear TV rights or any kind of programming or any type of network. So the company is going to keep their head down and keep things going the way it has been. Now, moving over to technical segment. This thing's been on a rocket ship. It's flattened out a little bit, but boy, we have really comfortably traded at the top of a channel, looking NVIDIA-like, if you will, and we've broken out to the top of the channel. With these breakouts, there's nothing that really excites me here. They tend to fizzle out. We should have, there was huge consolidation during the pandemic era between like 500 and 600 on Netflix. Gotta imagine some sellers emerge at that area, push these things back down. I know I put a big red candle on there, but you get this big opportunity in Netflix. It would be a resumption of trend, take you down here south of 400. Other than that, I'm just not convinced with Netflix and the entire entertainment industry that it can return to this like pre-IPO or like post just IPO performance. I think you're keeping up with the NASDAQ. I think you're keeping up with the S&P 500. But in terms of outperformance, I just don't think Netflix is going to really broadly outperform the broader markets. In that case, I'd probably rather only allocate a small position into Netflix. Maybe for outperformance, I'd go hunting in small caps, maybe semiconductors as well. Folks, that was Netflix's Q4. We'll be back again tomorrow for Tesla and on Friday to recap everything. Hopefully, you guys have a wonderful day out there. Be back again soon. Good luck with your investments.